Finance fun fact. When Roger Smith became chairman and CEO of General Motors in 1981, the company had been losing market share to both its American and Japanese rivals for decades. But in the same year, it got a little bit of breathing room when Japan agreed to put a cap on auto exports to the US for the next 3 years. And these years became very profitable for the company and gave it a large war chest for acquisitions. Roger Smith knew that GM was behind and thought the company could leapfrog its competition by buying its way into the 21st century. Granted, GM had not done a major acquisition since the 1920s, but they'd figured it out. GM settled on buying a company called Electronic Data Systems, or EDS, for $2.55 billion. EDS was started and majority owned by Ross Perot. Even though EDS had zero manufacturing prowess, GM did spend nearly $3 billion a year on data processing costs, and GM wanted EDS's enterprising and entrepreneurial culture to diffuse into their own. In this deal, Perot personally received $930 million of cash and 5.5 million shares of GM's Class E stock. But instead of just sailing into the sunset, Perot got a seat on GM's board and became an active voice. After all, he was one of the largest individual shareholders of the company now. And to figure out why GM's cars were both more expensive and lower quality compared to its Japanese rivals, Perot dropped in on dealerships and spoke with factory workers and met with executives. But Perot's recommendations for change were very far-sweeping and radical, especially for GM's entrenched management. And it all came to a head in June 1985 when GM announced its acquisition of an aerospace manufacturer called Hughes Aircraft for $5 billion. Perot had already seen firsthand the challenges of integrating EDS into GM and thought this acquisition of the random aircraft manufacturer was just a distraction. Perot ended up being the sole director to vote against the merger, and the media almost immediately caught on to the schism in the board. And it's worth noting that the directors on GM's board were venerated titans of industry. It comprised the current and former chairman of companies like CBS and Procter & Gamble and Merck and Pfizer, Amex and Union Pacific, companies that were the largest back in the 80s. Needless to say, Perot's quarrel with the other directors at GM was a major deal, and the board was fed up. It had enough, and it proposed to buy out all of Perot's stock in the company for $700 million, which worked out to about $62 a share, which was a massive premium to the $33 the same shares were trading for on the open market. Perot signed the proposal to buy him out, thinking that there was no way the board was actually serious. Or if the board was serious, it would transmit a very strong message to the public that GM had gone so far astray that it was willing to buy out one of its own directors for nearly $750 million. But the board, it signed off on the deal. And when the news became public, shareholders and employees and the public at large were livid. And in a slight twist, Perot actually socked away his $700 million in escrow and publicly came out against his buyout in a press release that looked like this. Understandably, GM's management was pretty shocked that Perot was trying to intentionally sabotage his own golden parachute, and they privately thought he was just trying to get out ahead of accusations of greenmailing. But the board pushed on, and Perot quietly resigned with an enormous check. At GM's annual meeting the next year, the shareholder proposal to rescind Perot's buyout received 20% of the votes, which doesn't seem very high, but you have to keep in mind at previous meetings, shareholder proposals were almost unanimously voted down. So for the venerated GM, 20% was a shock and embarrassment. Perot, for his part, became even more wealthy. After his non-compete expired in 1988, he started a new company called Perot Systems, which was sold to Dell in 2009. And Perot also became an angel investor in Next Computer, which was Steve Jobs' venture after Jobs was fired from Apple. And Perot also spent lavishly on his two campaigns for US president as a third-party candidate. His first bid in 1992 was pretty successful. It captured 19% of the popular vote. How the events unfolded in this episode between GM and Ross Perot is especially interesting to me because it was a wake-up call to institutional investors like pension funds and endowments. It caused a thematic change in how these investors view themselves as shareholders. They went from passive owners to active shareholders who began to more carefully scrutinize management's motives and moves. Hope you enjoyed this